Hi everyone, and welcome to Keep Calm and Money On, your personal financial coaching channel, where our goal is to give you peace of mind and security when it comes to your finances. Today's episode is going to focus on the dreaded student loans. We're going to start off by discussing the difference between private and federal loans, and then we'll answer the question of whether it makes sense to aggressively pay off your loans or enroll in one of the income-based repayment options offered by the federal government. But before we get started, make sure to click the subscribe button below the video so you don't miss any new episodes. New episodes will be posted every Monday. Okay, let's dive in. I've wanted to do a video on student loans for a while now. After all, it's a hot button issue at the moment, as the current outstanding debt for student loans is somewhere around $1.5 trillion, and it's rapidly increasing. The amount of student loan debt currently outstanding has even surpassed credit card debt. The problem is that young people coming out of college or graduate school today find themselves with a negative net worth and tens of thousands of dollars to pay back without even having an established career yet. The stress and sheer magnitude of making the payments every month is causing young people to delay important milestones, such as getting married and having children. Some people are so bogged down by the amount that they have to pay every single month that they don't think they will ever be able to afford to have children. This is obviously a huge issue in our society right now, but it does not have to be this way. And I'm not saying I have a time machine and I can reverse your decision to take out debt in the first place. I certainly would have done that for myself if I had the necessary tools. What I am saying is that if you're already in a position where you owe 6 figures of debt, or even less, you're not hopeless. There are options out there that will help you reach financial security, but that requires a plan. A lot of people ask me what the difference between federal and private loans is. And while the answer is not brief or an easy one, it doesn't have to be difficult or overwhelming either. Let's do a comparison of the two. Federal loans are provided by the government and usually serviced by a company that the federal government contracts with. That may be Fed Loan Servicing, Navient, or other such entities that you've probably heard of or dealt with. Private loans are provided by banks or other financial institutions that are not affiliated with the government, but may also be serviced by those same companies that service federal loans, such as Navient or Sallie Mae back in the day. Interest rates on federal loans are set by Congress and are fixed, meaning once you've signed that loan contract with the government, whatever the interest rate was at the time the contract was signed will be the interest rate for the life of the loan. So it will not increase or decrease unless you refinance or consolidate, whereas private loans tend to offer variable interest rates, meaning the interest rate can be increased or decreased based on market conditions. This variability can make it very difficult for you to predict how much you'll pay in interest. The other difference between federal loan interest rates and private loan interest rates is that private loan interest rates tend to be higher. Now, don't get me wrong, federal interest rates are still exorbitantly high in my opinion. Considering the reason behind the loan in the first place, I think it's highway robbery. But in comparison with private loan interest rates, federal loan interest rates are somewhat lower. Couple the fixed interest rate with the fact that federal loans typically offer lower interest rates, federal loans are superior to private loans in this capacity, in my opinion. Are you with me so far? Comment money goals in the comments below to let me know that this makes sense. When it comes to your monthly payment amount, federal loans and private loans diverge even further. Federal loans offer a variety of repayment options, including standard repayment, which usually calculates a monthly amount based on a repayment term of 10 years, and then there are the income-driven repayment options, which break down into 4 options. There's the revised pay-as-you-earn, or repay, pay-as-you-earn, or pay, income-based repayment, IBR, and income contingent repayment, or ICR. I'm going to very briefly go through each repayment option, but I plan to delve further into them in a future episode, as I don't want this one to go on for 45 minutes. The revised pay-as-you-earn or repay option carries a monthly payment that is 10% of your income, recalculated every year based on the past year's income. After 20 years, or 25 years if direct loans were taken out for graduate studies, of qualifying payments, your loans are forgiven. Now I want you to put an asterisk by that word forgiven because it's a very important aspect that I will get into later. The pay-as-you-earn or pay option carries a monthly payment that is also 10% of your income. Again, recalculated every year based on the past year's income. After 20 years of qualifying payments, your loans are forgiven. If you're married and file a joint federal tax return, your spouse's student loan debt and gross income are also considered. So keep that in mind. The income-based repayment or IBR option carries a monthly payment that is generally 15% of your discretionary income. After 25 years of qualifying payments, your loans are forgiven. If you're married and file a joint federal income tax return, your spouse's eligible student loan debt and adjusted gross income are also considered. The income contingent repayment or ICR option calculates payments that are adjusted based on your income using the lesser of 20% of your discretionary income or the amount you would pay under a fixed repayment plan over 12 years. After 25 years of qualifying payments, your loans are forgiven. And again, if you're married and filing a joint tax return, your spouse's loans and income are also considered. So those are those 4 income-driven repayment options. In addition to these federal repayment programs, there are also repayment options for people who work in the public sector, such as non-for-profits or government entities. I'm not going to get into that now, but comment PSLF, which means Public Service Loan Forgiveness, in the comments below to let me know that you would like this topic covered in a future episode. Private loans differ greatly from federal loans when it comes to your monthly payment. With private loans, the loan service provider will calculate the monthly amount you owe based on the total balance owed, the interest, and the term of the loan. This amount is set, meaning you have to pay it no matter what. So in my situation, for example, my private loan payment was roughly $1,100 a month. That was the required sum each month, regardless of whether or not I had the capacity to pay it. While you are enrolled at least half time in a post-secondary school, whether that be in college or a graduate program, your loans, federal and private, are usually deferred until graduation. Deferment is the process that allows you to postpone your monthly payments for a set period of time. While you're in school, that period of time is until you graduate. Keep in mind that just because your loans are deferred while you are obtaining a degree, depending on the type of loan you have, interest may still be accruing. Upon graduation, most federal loans defer your monthly payment for 6 months. This is a huge help if you find yourself without a job immediately after graduating. During the life of your loan, you may defer the loan up to 3 years. After that, you lose the ability to defer. Private loans, on the other hand, are not as kind. Your first monthly payment on private loans become due immediately upon graduation. While you may have the option to put off the payments by paying a fee to the private loan servicer, not all service providers offer this option. So absolutely check with your particular provider to make sure you don't find yourself missing any payments while thinking that your loans are actually in deferment. Another option, similar to deferment, is called forbearance. With forbearance, you are again putting off your monthly payments for an agreed upon period of time. However, regardless of the type of loan you are forbearing, interest will continue to accrue during the forbearance period. Again though, not all private loan servicers offer forbearance, so check with your servicer before stopping payments. A huge note here. Continue to make monthly payments even after you submit your application for deferment or forbearance. You are still responsible to make those payments until you receive confirmation that your application was granted. Following me still? Type "still here" in the comments below to let me know I haven't lost you. Okay, now that we've covered the glaring differences between private and federal student loans, let's discuss which loans, in my opinion, are less awful to have. Look, I'm never going to promote or encourage someone to take out student loans. So if you're already saddled with them like I am, let's focus on the best of the worst of the two types. Federal loans are the clear winner here, mostly because of the income-based repayment options and the flexibility they offer. If you suffer some type of financial hardship, lose your job, or take a pay cut for one reason or another, federal loans offer the flexibility to be fluid like your income, moving up and down just as your income does. Depending on the amount you make, your monthly payment may even be as low as $0 per month, and that still counts as a qualifying payment. Private loans could not be any more different in this sense. They are completely rigid in that, financial hardship or not, the monthly amount you are set to pay is the amount you must pay no matter what. For just this reason alone, I recommend aggressively paying off your private loans. Not having that rigid payment that fails to consider that life happens helps eliminate at least some stress that goes along with having debt in the first place. Now back to that asterisk I wanted you to put next to loan forgiveness. So remember how earlier, when we went through the various federal income-driven repayment options, they all basically stated that after making 20 to 25 years of qualifying payments, the loan balance that's left over, if any, is forgiven. Well, there's a bit of a catch here. Any remaining loan balance isn't actually forgiven in the normal sense of the word, but rather any amount remaining is considered no longer due to the loan servicer, but instead added as income as though you earned it through a regular W-2 job, which is then taxed in the year of the forgiveness. Whoa, that's a lot. What am I talking about here? Okay, let's say you have $200,000 in federal student debt. You're on the income-driven repayment option described earlier, and you make monthly payments equivalent to 10% of your income. Very likely, depending on your income, the monthly payment does not cover the interest that accrues each and every month. So the total outstanding balance continues to grow as you inch closer to making payments for 20 years. After that 20th year, you have a remaining balance of $300,000. I know you're wondering, how could that balance have increased even though you've been paying for 20 years? But that's what happens when your monthly payments don't even cover interest. The interest grows, but the principal balance remains untouched. Anyway, so you have a remaining balance of $300,000 that is forgiven by the loan servicer. The year it is forgiven, that $300,000 is added to your income for that year as though you earned it, skyrocketing you into the highest tax bracket and triggering a tax bill of tens of thousands of dollars. Sounds crazy, right? Calling it loan forgiveness is the biggest misnomer known to mankind. But I digress. Now that it's all laid out in front of you, you're probably more confused than ever as to how best to proceed. So here's my rule of thumb. If you have private student loans, pay them off as quickly and aggressively as possible. If you have federal student loans that are less than 1.5 times your annual salary, pay them off as quickly and aggressively as possible. Pull the Band-Aid off, get rid of them. Free up that cash flow so you can be the boss of your money. But if you are like many people out there whose federal loan debt is more than 1.5 times their salary, go with the income-driven repayment option that offers you the minimum monthly payment and simultaneously save and invest for the tax bill that will be triggered once your loan balance is forgiven. You might be wondering why I'm discussing this option rather than telling you to pay off all your loans, no matter the amount, as quickly as possible. But it's because once your loan balance is more than 1.5 times your salary, the monthly payment to pay off the amount in a relatively reasonable period of time, that is like 10 years, would likely require such an exorbitant monthly payment that you would either not be able to spend a penny on anything else or simply not be able to afford it. The total amount paid out for making minimum payments for those 20 years and paying the tax bill at the end of those 20 years will likely be less than any other option available. And honestly, it's really not that bad of an option at all. You could still get your finances in order while paying the minimums on your federal loans. You can still set financial goals and strive to achieve them, even while saving up for the tax bill. All you need is a plan and willpower. I know you can do it. Whew. That was a long one. I hope you're still with me. Give me a thumbs up or a thumbs down to let me know what you think about the comment. And if you found this episode useful, share it with someone who might find it helpful as well. You might think you're the only person struggling with all of this, but I promise you that there are more people out there who are just as eager for more information, but simply don't really know where to turn. Next week, we're going to discuss the top 3 strategies for people on the precipice of college who want to avoid taking out loans. So make sure you click the subscribe button so that you'll be notified as soon as the new episode is published. It's going to be a great one. I'll see you then, and don't forget, keep calm and money on.